Well, good morning and welcome back to the Broadcast Retirement Network. I'm Jeff Snyder, and this is BRN AM for Saturday, September 12th, 2020. And our top story this week, the 401k may no longer make sense for savers. Well, joining me now to discuss this and more is Bloomberg opinion columnist and the author of The Poker Face of Wall Street, Aaron Brown. Aaron, welcome to the program. Thanks for joining us this morning.
Thanks for having me, Jeff.
It's always great to talk with you. And I want to really focus on some of the recent pieces you have authored about the U.S. retirement system. So why don't we set it up? I know that you had some thoughts about the 401k in particular. What are some of those thoughts?
Sure, and it is a much bigger problem than 401ks, of course. Americans are saving nowhere near enough for retirement. And that goes with individuals saving for their own retirement in 401ks and IRAs and other plans. But if you're depending on Social Security, we haven't been funding that. If you're depending on a government pension, we haven't been funding those. So we got this gigantic looming problem. Now, I'm not going to tackle the whole thing today, but
of course,
401ks are a big part of it. So we had this program, and it wasn't a government program. This is very important to remember. The government, with the ERISA Act in 1976, basically killed private pension plans. They made them so safe that nobody offered them. And a private individual came up with the idea, basically a loophole, to fund the 401ks. Initially, the government resisted it, but eventually they embraced it, and it became the mainstay of retirement planning for private workers, non-government workers. And when it was introduced in 1980, it was a tremendous deal. If you were a baby boomer like me, and you started your 401k in the 80s, and you contributed regularly, you got rich. You had this great stock market, the greatest bull market in history. You didn't pay taxes, even when marginal rates were very high. And you're left with this great retirement nest egg. But for a median or lower wage worker today, those tax advantages have evaporated to the point where for many, many workers today, the 401k is no longer a good deal. And that's two problems. Number one, it means basically these workers have no means to save for retirement. They are entirely dependent on the government to pay their living expenses in retirement. But also, it's kind of a trap. It's pushing people into something that is no longer a good investment choice. Now, my solution is we have to fix 401ks. I think it's great. I think people should save for their own retirement if they can. If they can't, okay, we need government assistance for some people. But anyone who can save for their retirement should. And there's a very important reason for that. It's not just a moral thing. If you save for your own retirement, the most important skill you learn is budgeting. That is, by taking regular money out of your paycheck, you spend less. When you get to retirement, you know how to spend less, so you can live on whatever money you have. If you never learn that, if you spend every penny you make and you borrow more, no amount of money will save you in retirement because you won't have learned how to discipline your spending. So the 401k should be a great plan. It still is a good plan if you're an upper income worker. If you have a good employer match, if you have good employer options, if you're in a 24%, 7% tax bracket, the 401k is great. But if you're down there in the 10 to 12% tax bracket and you're struggling along trying to raise a family on $40,000, $50,000 a year, the 401k no longer works.
So Carl, I mean, there are many members of Congress and regulators who watch the show or are part of our audience. We're obviously coming up on an election year, so a lot of policy discussions happening. What are some solutions? I mean, you mentioned budgeting, and clearly financial literacy is a big component to this. If people understand budgeting, which I would suggest is part of financial literacy and wellness, that would help them a long way. But what are some ideas that you have or that you're suggesting to make this a better program? Because I think everyone agrees it's definitely not a perfect system.
No, it's not. Well, let's start with Joe Biden. The Biden-Harris ticket has come up with a proposal and that is to get rid of the tax deduction for 401k contributions and IRAs as well, and replace it with a refundable tax credit. I think that's exactly a step in the wrong direction. It's what they're saying is we're going to tax your 401k plan when you contribute to it,
Mm-hmm.
and we're going to tax it when you take it out. And in exchange for that double taxation, we're going to pay you some money. Well, the problem with the reason people can't save for retirement, there are two of them. One of them is the tremendous tax burdens the government puts on accumulating money. If you don't pay taxes just once, you make an investment, so you pay taxes, you take the money, you invest it, you get return on that investment, the government taxes it, then you get to reinvest it, and then you get taxed again when you get more return on it. And it adds up to, for example, if you are in the 22% tax bracket, you actually end up paying 41% of your total retirement savings. The government takes 41% of your total retirement savings. And it's much higher when you start including state and local taxes, and you start including, things like the Social Security tax or the Medicare Part B and D premiums, ACA subsidy removals. So what we got to do is we got to reduce the taxes on retirement saving, not increase them, and then bribe people to accept it. The people we want to reach are already ignoring their 401ks, and they may be ignoring 100% employer match. So the government offering a 35% match on top of that is not going to change their behavior, especially if the government then taxes back the benefit of that by adding one more layer of taxations to 401ks. So one thing I think we got to do is we got to really reduce the taxation on deferred retirement assets. If you want to put money away for retirement, there's just no reason for the government to get in your way with taxing, taking part of your portfolio, at least for median and below wage workers. If you want to tax 401ks once they get over $1 million, fine. I mean, that's a totally different issue to me. But, as long as you're saving a reasonable amount of money for retirement, that should be all yours. The other big problem is the government takes too much money from people when they earn it. And again, I'm talking about median below wage workers. And it's primarily the Social Security and Medicare payroll deductions. And I assume that the employer match to those comes out of salary. So that means over 15% of their wages are taken off the top.
Right.
You're trying to support a family on $40,000 a year, taking 15% off the top, that's $6,000. You're probably not paying a lot in income taxes, but you have other taxes and you got other expenses, and that, you take that $6,000 off the top, where is the person supposed to find money in the budget to save for retirement? So I think the fixes are to reduce payment taxes on median and below wages, increase the earned income tax credit, which is the best provision of the tax code, in my opinion, and just get rid of the taxes on retirement savings up to some reasonable level.
And, Aaron, I mean, given that this is an election year, there's a lot of policy. You mentioned the Vice President Biden's policy plan. Clearly, the current president will have his plan. And you never get 100% of what you want, even if you're elected, right? There's always compromise. We don't know what the Congress is going to look like, the Senate. But is there any opportunity, do you think, in this coming election to, A, get the word out so that people can kind of wrap their arms around this? I think that, in my opinion, retirement is, we're in real need of a national conversation about retirement. And these issues, taxation and budgeting and financial awareness and preparedness, they're all part of that.
Well, I'll tell you, the next thing that's going to happen, I mean, listen, we've been talking about these issues for as long as I've been alive, and occasionally make a little bit of progress. There's a little Social Security reform or the 401k plan, which was a tremendous innovation. But politics is not proactive, it's reactive. And the next thing that's going to happen is state and local governments are going to admit that they cannot pay their pension obligations. That's going to be the
huge
trigger that unleashes a tsunami of debate, and basically, Illinois, New Jersey, California, places like that are going to become like Detroit and Puerto Rico. And how that gets resolved is going to be the first leg in this discussion. Once that is resolved, good, bad, however, whether the federal government bails everybody out, whether we put all government workers on Social Security, whether, all the municipal bond creditors take the loss and we just, wipe them out, whatever, one way or another, that's got to get resolved. And it has to, because these funds are running out of cash. It's no longer an actuarial problem. It's a problem of one day in the next 5 years for some of these plans, they won't be able to pay the pensions. And once that happens to one major plan, we got to resolve it for everybody, because if one state gets to walk away, every other state is going to say, hey, we're going to walk away too.
Right.
Once that happens, I think then we will have opened a window, a brief window, to really impose a rational solution. Kind of like, the Great Depression opened the window for a whole raft of plans, including Social Security. Which some worked, some didn't, some ups and downs, but we really managed to get radical change in a fairly short period of time. I think that's what we're going to need. I don't believe that it is politically possible to reform this around the edges. The political bloc of people my age, either receiving Social Security or anticipating it soon, is so powerful you cannot touch those benefits. If you can't touch those benefits, then you can't really start working on the problem. Yeah.
Well, Aaron, I'm an optimist. I'm going to hope that we can work things out before a tsunami, as you're talking about. But yeah, I think a lot of people recognize that pension funding is a big issue, and it's going to be a big hurdle for all of us to manage through. Aaron, thanks so much for your appearance on the show today. Really appreciate it. Thanks for sharing your perspective.
Thanks, Jeff.
Well, thanks, Aaron. And when we come back, we'll take a look at some of our best segments of the week. You're going to want to stay tuned right here on BRN Weekly. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
If you are like 58% of Americans, you didn't go to college. Or you did, but never finished. Maybe it's the thought of a big, intimidating campus. At Independence University, all classes are held online. Maybe it's the thought of being alone in a sea of students. At Independence U, you'll get a personal support team to help you every step of the way. Maybe it's the cost of all those books and supplies. Online means no books to buy. We even give you a new laptop and tablet to keep when you graduate. Maybe your life doesn't fit typical college classes. At Independence U, our online college fits your schedule. Let's meet a few students.
Independence University held my hand through the process.
Don't be afraid to take the leap because it has changed my life drastically.
Just take the first step and you can do it. If I did it, you can do it too.
At IU, there's no barriers to your degree.
800-535-9916.
Welcome back. On Friday, I sat down with Money Alignment Academy's George Grombacher to talk about aligning your financial plan with your values. Let's take a look.
I think that
that our perspective on the world is one of the most important things that we have or we don't have. If I have a healthy perspective, if I'm viewing the world and my situation through a healthy lens, then that's going to inform the way that I'm using my most important resources, like my time, my money. It's going to change my spending behaviors, my consumption behaviors. So I really do believe that knowing, really clarifying and crystallizing what a person's values are is essential to success in many areas, but certainly personal financial success. We're obviously dealing with a lot of difficult issues as a community and as a country right now. It's police violence, income inequality, global warming, you name it, it is a long list. So this is what you just described and what you ask about, is there a desire from a plan sponsor to have a conversation or to better understand the role that an ESG kind of investment would play inside of their retirement plan? So people are curious about that. And there's always going to be people within an organization, the actual people using the 401k, who are interested in those more social issues. So certainly we are having those conversations right now. And I think it's going to be interesting to see what shakes out with the rules. I'll be honest, I'm not 100% up to speed with what's going on with legislation surrounding the funds, and it's always been curious to have conversations with people about the performance of them, as to whether or not, again, that's the reason we're having these conversations, are these appropriate investments to have inside of 401k plans? But yes, people are interested in investing in places that are socially responsible, and they want to be able to have financial success at the same time. So is it possible to have your cake and eat it too? Well, I guess we'll see. Today's world demands it. Today's environment demands it. When you have all this wonderful financial technology, all this wonderful fintech and new players coming into the marketplace that are doing such an incredible job, from aggregating my data to helping me with professional asset and money management, and there's companies offering free financial plans and this, that, and the other thing. So if you are a financial advisor who is not having conversations about the more qualitative stuff, well, I think you're going to be left behind, and you're going to wake up in a couple of years and you're going to think, oh my gosh, did the industry just leave me behind? And I'm always hopeful, because I do have conversations with financial advisors all over the country, and there's so many good ones out there. So I certainly do know that it's possible, and I know that there's a lot of good ones who are doing it. For those who are reticent, I say, well, I mean, it's almost irresponsible from my perspective if you're not talking about with your clients the importance of, again, knowing your priorities, knowing your values, knowing what's more important to you, and then working to align all of your money activities with those values. I think it's going to be really interesting, Jeff, when the rubber meets the road on this and we actually see how much money is going to be flowing into these kinds of investments. Is it a nice talking point? Is it a nice to have versus I'm actually going to put my money into these investments? And I don't know the answer to that question. We're just going to have to wait and see.
And on Thursday, I sat down with former Assistant Secretary of the Employee Benefit Security Administration, Preston Rutledge, about things that investors and employers need to know about the new ESG regulations. Let's take a look.
So before the break, we were talking a little bit about the importance of documenting your prudent process. There's a second place where the proposal mentions documenting your prudent process. And that has to do with something that has also been in the guidance for many years, known as the tiebreaker rule. And the tiebreaker rule is the concept where if a fiduciary is looking at I'll simplify it sort of as much as I can. If a fiduciary is looking at two different funds, for example, two different investments, and I think the phrasing originally used was, if all things being equal, these are identical in terms of their objective risk return criteria, but one has ESG as an ESG element and the other does not. If it's all things are being equal, the fiduciary may choose ESG as a tiebreaker and then go with the ESG fund. That's the concept of the tiebreaker rule. And the proposal keeps the tiebreaker rule, but it does, and you'll see this in the preamble, the department does express some skepticism about the frequency of ties. It doesn't deny that a tie can exist. That's been part of the department's analysis for a long time. But it does express skepticism that they occur very frequently, and there is a concern that the tiebreaker could be used as a workaround of the original core point we made in the first segment. Seeing a tie where maybe a tie doesn't really exist so that you can do an ESG investment when otherwise you would be precluded under that basic core principle. So in order to deal with that, the proposal also explicitly requires that the fiduciary who thinks they have a tie on their hands, that they document the prudent process they've gone through to determine that, well, there is a tie. So somehow, document that why are these investments not distinguishable? So that's there, and that's getting a lot of attention. But once again, like we discussed previously, documenting your process is best practice and has been basically throughout the history of ERISA, and advisors like yourself in your previous life understand that quite well. Well, what happens now, and the public comment period did close, and this rule did get the most comments of anything the department has done in recent history. Well over 1,000 comments.
Go figure.
Posted. Yes, and from international organizations. I mean, I expected this at the time we were in the process of drafting it. It was in process before I left in May. Obviously, it didn't get published until after I left, but it was anticipated there would be a lot of comments. What happens now is the career staff has to knuckle down and read those comments, read them and categorize them, and try to create for the executive staff a kind of a list of issues and the pros and cons and the comments for and against. And there are comments in favor of a proposal. There's comments against a proposal. And usually the comments will focus on, most comments are not generally for or against the entire proposal, up and down. They focus on particular issues. And one part very definitely pays attention to that. Excuse me. In my experience, rules are almost always adjusted at the final stage to accommodate comments that come up. I mean, the public comment period is very valuable to the department. There's no, monopoly on wisdom at the DOL, and they know that. And with professionals in this world of pension investing are a lot of very, very important expertise out there, and the public comment period allows EBSA to tap on that. I'll give you one example. I'm going to be fascinated to see how this turns out. There is one part of the rule that got a lot of comments. It's the part of the rule that says, we mentioned earlier, that if you go through your prudent process, a fiduciary may decide to put an ESG-oriented fund up on the 401k menu for participants to choose. The rule does draw a line and say that you may not, however, even if you've gone through that prudent objective risk return process analysis, you may not make that fund the default alternative, what we call in the industry, and you're familiar with, the QDIA, the qualified default investment alternative. The rule says that you cannot do that. Now that has gotten a lot of comment. And I think the commenters who criticize that, they have, I think, a fair point. The point they make is, once the fiduciary has gone through and the process, a prudent process, and chosen that investment based on objective risk return criteria, at that point, why does it matter what the labeling of the fund is or whether it's ESG or not? It's the fund that you expect to create the greatest risk-adjusted return. And I think that's a fair point. What the department had said in the preamble that explains their perspective, though, is also, I think, a fair point, and that's why this will be such a fascinating issue. And the perspective they make is, they explain is, when you're dealing with a default alternative, by definition, you're dealing with a participant who has not made an affirmative investment election. That's why we have defaults. People who have not expressed their preference for a particular investment. If they're defaulted into an ESG, that fund by definition will have will express certain social policy objectives, E, S, or G perspectives. And it will be the fiduciary who made those choices. So there's a discomfort with defaulting someone who has made no choice into a fund that there's a concern that the fiduciary's personal preferences are being people are being defaulted into a fund that reflects the fiduciary's personal preferences. So that concerns the department with respect to what we call under ERISA the duty of loyalty. So it's a fascinating issue. I'm going to be very interested to see how the department works that one out. I've even read recently, like yesterday, if you don't mind my mentioning, there's a journal in the UK known as the Responsible Investing Magazine, and they wrote an article about it just on Tuesday, and they pointed out interestingly that it was interesting. They said that the rule overall made a lot of sense. They thought some of the criticisms were a little overwrought. That the rule makes a lot of sense, but they did point out this one perspective on the QDIA, and they called that into question and thought that was one place where they thought the rule might have gone too far. As the rule settles in, as people read it around the world, and it's particularly if you focused on the regulatory text, I think folks will find it's a workable rule. It gives you the path to doing ESG in an ERISA covered plan, but doing it properly and doing it in a way that continues to focus on the return on investment for the participants. And I guess the final sign off perspective on this and the department mentioned this in the preamble. Don't forget that pension plans and 401ks have built into them a very important social purpose, and that's the social purpose of providing retirement income for folks when their working lives end. That is in and of itself a very worthy social goal, and it's really what ERISA was designed to do from the ground up.
And that wraps up this episode of BRN Weekly. Have a topic of interest? Drop us a line. And don't forget, for all the news in retirement markets, technology, personal finance, and more, check out today's edition of The Morning Pulse. Don't forget, we're back again tomorrow with members of the media, academia, and financial services as we analyze all the news for the week on the BRN Sunday podcast. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
Are you being audited and do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and reduce your stress. The IRS can freeze your assets and seize your bank accounts, but you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a Tax Doctor now for a tax emergency analysis.
Call 800-224-6439.